Q1 earnings season is rolling on amid market uncertainties. This week was probably the busiest of the season. All indications are still analysts seem to be optimistic about earnings growth, though. Our research director, Shiraz Mian, here with me now to weigh in on what's going on. Shiraz, are you still optimistic about earnings growth from what you've seen so far?
Oh, absolutely, Terry. The results are better than expected. The growth is better than expected, and all indicators suggest that this could be one of the strongest earning seasons we have seen in a while. So all in all, yes.
So far as you can tell, do companies seem to be dealing with things like higher energy, transportation costs, and other issues that they're facing?
Yes and no. So yes, in the sense, Terry, that the U.S. economy, as you know, is very diverse. It's weighted towards technology and finance, and uh, technology kind of moves and dances to its own beat. Obviously, if the outlook for the global economy softens, that'll have a bearing on the outlook for technology. But uh, on the whole, it kind of is in its own lane. And as you know, it has been practically firing on all cylinders now for a while. So both of these areas are largely doing just fine. But outside of that, in the old economy, in consumer facing businesses, businesses engaged in either directly in transportation or using freight and transportation to any large degree in their business, those companies are showing signs of stress, and we are hearing from those. And I suspect we'll hear more as we get towards the retail side of the reporting cycle. But on the whole, they're doing fine.
What is the S&P 500 earnings per share at now versus where it's forecast to go this year?
So as we entered this year, Terry, uh, the outlook for 2026 was one of the strongest and one of the broadest base that I have seen in a very, very long time. In fact, of our 16 sectors, we had 15 on track to have positive earnings growth year over year in 26. Uh, More than half of them in double digits. The one that was modestly in the negative was energy, and even that is now positive. So a very strong earnings outlook. To the index EPS, uh, our data now works out to about $310 for the S&P 500. That's about 17% higher than what we penciled in for 2025, which was 264. And uh, the expectation is, and this is what we see in the marketplace. People are scratching their heads. Why is the stock market at all-time highs when we have oil prices where they are, where there's all of this turmoil on the geopolitics, and it's this earnings outlook. We have 17% earnings growth expected this year. All 16 sectors are expected to have positive earnings growth, more than half double digit. And then that same momentum carries into 2027. So, unless you seriously dent this very positive earnings outlook, I don't see any fundamental reason why the market should be worried.
All right, let's recap the scorecard.
So, including all of the results that came out this morning, we now have 288 S&P 500 companies. That's 57.6% of the index's total membership. Earnings are up 24.4%. Revenues are up 11.2%. 77.4% are beating EPS estimates, and 77.8% are beating revenue estimates. This is the earnings growth, the revenue growth, and the revenue beats percentage. Both of these three metrics are significantly better relative to what we have seen from this group in the recent past. The one lone metric that's not as impressive, still very strong, but not as impressive, is the EPS beats percentage of 77.4%. That's a hair under the 5-year average, the preceding 20-quarter average for this group. But all in all, a very strong showing, Terry.
Are margins still solid?
Absolutely. So as I noted, 24.4% earnings growth on 11.2% revenue growth. So about half of the earnings growth is coming from margins. And for this 288 index members that have reported, we are showing 137 basis point expansion. This same group had shown 60 basis point improvement in the preceding quarter. So we are showing even acceleration on the margin expansion front.
What's the corporate guidance looking like?
So you have that division that I was referencing earlier. In the aggregate, the guidance picture is positive and favorable, and we are seeing the effect of that in the revisions trend, both for Q2 as well as for the full year. But it depends on what company it is. There is a group of companies that are more exposed to some of the headwinds that you noted at the top, Terry, the high fuel costs and the result of that, the cumulative inflation. So we had GE Healthcare, UPS, a bunch of the air carriers, a number of them flagging freight transportation fuel as a headwind. And as I was referencing earlier, I would suspect that as we get into the retail results, we will hear more about that. But on the whole, to your question, guidance is positive.
The Q1 earnings results for some of the Mag 7 stocks took the spotlight this week as well. We're talking here on April 30th. And this is interesting because after big tech spent the first 3 months of this year dragging down the S&P 500, did they provide any clues now as to the sustainability of this market rally?
They did, Terry. And the results are truly off the charts. Not across the board for all the Mag 7s. Like we had 4 of them report last evening. Alphabet, Amazon, Meta, and Microsoft. And the Alphabet results in particular, they have been doing extremely well in recent quarters, and it seemed from the numbers that they have significantly accelerated even from that very strong pace, and across all of its businesses, but particularly those that are directly tied to their AI spend and cloud computing and related businesses. Amazon, the same thing. Very strong results on the cloud. In fact, the Q1 earnings for the Mag 7 as a whole jumped significantly after these 4 results. Now they're expected to be up 44.6% in Q1 and 24.1% higher revenues. And the commentary from these companies, particularly Amazon and Alphabet, also Meta, but not to the same extent and for different reasons. The commentary suggests that the momentum is is very much sustainable and not a one-off. So these companies have been truly earnings powerhouses, and this Q1 earnings results show once again that the earnings power of these businesses remain extremely strong.
Some energy stocks have reported also. Did they provide any kind of a read on the Iran war impact on the energy sector?
The tone on the whole has been positive, Terry. We have the super majors tomorrow, Exxon and Chevron. The services majors have reported, and the commentary on the whole is positive, and for understandable reasons. The underlying commodities, the outlook for that has received a boost from the turmoil in the region, and there is even this talk that even once all the kinetic action and the active hostilities come to an end, there will be this enduring Strait of Hormuz premium in oil prices, suggesting that we are not going back to where we were before the conflict, even if everything is resolved, all of which is a net positive for energy producers and the service companies that service them.
Going into this Q1 earnings season, Shiraz, published reports showed that an earnings boom was right around the corner. Is that what we're seeing now?
We totally are, Terry. It's like I noted at the top, we had 15 of the 16 ZAC sectors on track for positive earnings growth, half of them double digit for this year, and now all 16 are showing positive earnings growth. We are totally in the midst of an earnings boom, and the amazing part and the most interesting aspect of this seemingly contradictory development to what we are seeing of all the hand-wringing about the global economy and the outlook and commodity prices and what have you, that the U.S. economy is kind of an island in its own right. I'm not suggesting it's completely immune from what happens in the rest of the world, but the tech sector is and has been the envy of the world for a long time, and it still remains. It's a leader both in terms of its earnings power and what it invests for future. The country's energy self-sufficient. It is not a trading economy for the most part. It trades substantially with the rest of the world. The bottom line, what I'm trying to get at, Terry, is that even if commodity prices remain high as they have been, that's a huge hit to the Southeast Asian economy. That's a big hit to European economy. It's a negative for the U.S. economy as well, but not to the same extent. We could have very strong earnings, decent economic growth, and that should get reflected in the stock market as well, despite all of these global uncertainties.
All right. I want to remind all of our listeners that they can keep up to date on the earnings trends and issues in your written commentary on Zacks.com, accessible right off the homepage. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.